Deutsche Konsum is a German REIT, which is a tax-exempt vehicle. We invest in German property only. In fact, we invest in German basic retail outlets only. So we're talking about supermarkets, food discounters, non-food discounters. We're spread out over Germany. We are pretty much everywhere in Germany. We don't really care where we are, but we care a lot about the micro locations where we are in. So we really want to make sure that we're in the right locations in the cities that we are in. We're looking for strong tenants, we're looking for strong food anchors, and basically want to, this way, produce as safe as possible cash flow stream. I set it up because I had a very simple thought, which is that if you own one supermarket and the lease expires, then you really are at the mercy of the supermarket. He will tell you, well, you need to cut your rent, otherwise I will leave and not extend the lease, etc. And I thought, well, what if you have hundreds of supermarkets? Then you are effectively no longer the victim of the tenants, but you are a partner. You are a proper eye-to-eye partner. You can build a strong relationship. You de-risk this relationship. You can think about future products, like together investing into charging stations for electric cars. You can look into all sorts of other efficiency measures, and you can help each other, and thereby you de-risk the asset class completely, and thereby bringing it to a different risk reward, and also look to do much more lucrative things together in the future. Well, that's very simple, because if you look at our investment strategy, what we do is we go for the strong micro locations, we look for strong catchment areas, we've got super strong tenants. Everything that we do is very high quality and very low risk. But we do take one risk, which is the lease extension risk. And if you look at the German investment market, you will find that German investors are obsessed with lease length. So our product with lease length of 10 years, 12 years and longer will trade at yields of 5% or less. We typically buy at yields of around, at lease lengths of around sort of 5 years and less. And therefore we are able to capture yields of 10%, give or take. And that is very crucial. And of course, we can only really manage this lease extension risk because we have the relationships with the tenants, which allow us to take that risk. And therefore, since inception of the business, we haven't lost a single anchor tenant. And effectively for our shareholders, we do capture this massive yield premium because of the lease extension risk, which we are having to take. Well, it basically means that shareholders make money on 3 levels. First, we buy assets with very attractive yields. If you look at the past, then our rental growth has massively outstripped the growth of number of shares. So already buying assets has improved the metrics on a per share basis. And second, sort of the growing portfolio, our reasonably professional asset management, etc., has led to a significantly expanding margin, which means that the bottom line is actually outgrowing the top line, which in itself is already outgrowing the number of shares. And of course, in the third stage, what that really means is that the FFO per share, so the cash flow return per share, is growing very strongly and has been growing since inception of the business, and there's no reason to believe why that would stop. And that I find is really sort of the key here, because we're in an asset class which is per se very boring, but it delivers shareholder returns on a low risk basis, which are extremely attractive. No, not really. I think we have a couple of defense lines here. Firstly, our tenant mix is such that we are not really exposed here. We try to avoid electronics, for instance, completely. We have hardly any fashion, etc. Second, we avoid the really sort of high street inner city locations where people with not enough time but too much money are shopping. So we are actually sort of in neighborhoods where people are price sensitive. And if you're price sensitive, then it really means that's really tricky to compete online with those offline retailers that we have. And because Germans, I'm afraid, are very price sensitive, not very quality sensitive, and because we Germans don't really like paying for service, presumably because we're so bad at providing services ourselves, so the classic online grocery sales strategies that work in literally any other country of the world have not really kind of worked at all yet in Germany. And I don't think they will. And if you look at sort of offline retail in Germany, even last year with the whole COVID-19 thing, and the offline retail in our segment has actually been growing to record levels. So we take this very seriously, but I think we have a couple of measures in place that means that our cash flow stream is quite well protected from the threat of online retail. But the market in Germany is huge for our asset class. It's probably sort of 150 billion euros. Nobody knows exactly because it's so intransparent and so fragmented, which in a way is part of the reason why we can be so successful. I mean, we are probably one of the largest player. We may be the market leader. We don't even know. Our market share is way below 1%, which means we're not in daily contact with the cartel office. But of course, we can be very nimble, we can be fast, and we have a constant pipeline effectively, because every year, every lease is 1 year shorter. And therefore, all those people that are very sensitive towards owning long-term leases, they will always kind of create product that has shorter leases. And that's where we can come in and buy these assets. So the market opportunity is simply huge.